We are excited to host another out-of-the-box video on demand. This meeting will include a brief presentation from two of our financial advisors, both who are members of the investment committee. They will present thoughtful insights about the markets and the economy. This is in addition to the quarterly newsletter that is sent to you and available on our website. I now introduce to you Doug Box and Cyrus Shabaz.
Welcome, and thank you so much for joining us for this episode of Out of the Box on Demand, where we want to give you a glimpse into our thoughts and activities that our investment committee has been considering in order for us to manage the portfolios in this coming quarter. And with us today, as always, we have got Cyrus Shabaz. Thank you so much for joining us today.
You're welcome.
Oh my goodness sakes, it's always a good time.
Absolutely.
So in today's presentation, we're going to be really focusing on the various factors that influence our portfolios the most over the last quarter, what is happening and affecting the portfolios most today, and then as we look into 2025, what things are going to be the most impactful for our portfolios as we walk our way through this year. In addition to that, we're going to be really kind of hitting on a little bit of what things over the last quarter had the greatest impact to our portfolios specifically. And then lastly, we're going to tackle a tough question that has kind of come in, and a very, very popular question, and that is, what should we expect with the second Trump administration? So again, stay tuned for the ending because that's our last question that we're going to have. So Cyrus, help us out. Like over the last quarter, what were the main drivers that contributed to the way the portfolios and the markets acted?
Well, in December, the Federal Reserve lowered interest rates by 25 basis points.
Okay.
This was on top of September's 50 basis point reduction and the 25 basis point reduction that we got in November. So this, again, kind of signaled to us that the Federal Reserve is seeing their inflation target of 2% coming out.
Yeah, they must be quite confident because, again, a 1% move in that short of a time frame is we would say, relatively ambitious.
Yeah, exactly. And this was on top of a United States presidential election. That the S&P 500 was up 4.5% for the quarter.
Wow, that is really impressive. That was a very impressive performance.
And this month is the fourth quarter earnings season. Okay, so we're expecting a strong earnings growth rate of 12.1% for the S&P 500.
Wow, for all of 2024?
For all of 2024.
That's a very impressive.
Yep.
And definitely way above where we started the year as expecting.
Yes.
So Cyrus, again, with all of that happening, kind of setting the stage for what's going on right now, what is kind of the big drivers that are happening at this moment?
Well, the unemployment rate is 4.2%. In November. This is still below the long-term average of 6.2%.
Okay.
The November CPI, that's the Consumer Inflation Index. This was up 0.3 for the month and 2.73% year over year.
Okay.
Now, from a producer standpoint, that's the PPI.
Yeah.
The PPI was up 0.4 for the month and 3% year over year. Now, that is important because the big monthly pop was due to food and energy costs.
Oh, well, and energy costs, I mean, they traditionally are kind of a tailwind to inflation, right? Which, again, inflation's not exactly good, and so a tailwind for something bad is not exactly great.
Exactly. And last but not least, retail sales. Now, retail sales was up 0.86% for the month.
Okay.
0.86%.
That's great.
And 4% year over year. And so that signaled to us that the consumer is still wanting to spend.
Yeah, and what we also noticed is that the debt level of the consumer is starting to grow, which again I think we can handle a little, right now for a while because the consumer was in such great financial shape that they can certainly handle taking on a little bit of debt. But the trend is, again, the thing that we probably are a little worried about, that we can only go so far with that. And at some point, again, they're just going to not be able to continue to whip out the credit card every time they want to spend more and deal with all these higher prices. So,
exactly.
That's interesting. All right, Cyrus, so it's that time where, again, it's time to bring out the crystal ball and try to help our wonderful clients at home identify what things are we seeing that not only for this first quarter of 2025, but as we look at the entire year, what things might we be thinking about?
Well, Doug, instead of giving you three predictions, what I'd like to do is share with you three questions that we're working our way through.
All right, excellent. I love it.
Question number one, the 10-year Treasury is currently sitting at 4.6%.
Okay. Isn't that a lot higher than where it began the year?
Absolutely.
Okay.
Absolutely. Wow. And so the question is that are we going to hit 4% or are we going to go to 5%? Okay.
Yeah.
So the 10-year Treasury has moved up from 3.6% this fall to 4.6% right now.
Now, hang on a second. Did you just tell us the Federal Reserve lowered interest rates by 1%? But now the 10-year Treasury is actually up 1%.
Yes. Ever since they lowered interest rates, the 10-year Treasury went higher.
Yes.
So now we actually have a more, not a inverted yield curve, but a sloping, generally sloping upward yield curve.
Which is a little more traditional.
Which is much more traditional. Yep. So again, if interest rates have peaked and they're starting to work their way down, or if interest rates peaked and they're just going to stay here, that's going to help the stock market flourish.
Okay. I like
but
that.
if interest rates go to 5%, I think what you're going to find is the stock market is going to kind of lightly tap the brakes to digest a 5% 10-year Treasury rate.
Because we haven't had that in quite a while.
We haven't had that for quite a while.
Yep.
But I think ultimately the stock market moves forward. Because remember, back in the 90s, we had double-digit S&P 500 growth.
Yep.
And the 10-year Treasury was at 6.5%.
Yeah.
So it's a matter of perspective.
Absolutely, because a 5% 10-year Treasury is not that unusual. It's actually fairly common.
Very common. Question number two.
Okay.
In 2025, is the labor market going to remain tight? Okay. Lately, the unemployment rate has been drifting slightly higher. But remember, we were at 3.4% not too long ago. That was in 2023, and today we're sitting at 4.2. And so as you remember, that the Federal Reserve is constantly looking at unemployment, and they feel that 5% we're at full employment.
Okay, so we're still a little bit below what you would classify as a little tight still, right?
Yes. So I think that the question is that yes, I think the labor market is going to remain slightly tight.
Okay.
In two things. Number one is, we are possibly facing some deportation. Okay, that's going to require a lot more people.
Yep.
And number two, I think the effects of higher tariffs is also going to put a more strain on the labor report.
Yep.
So out of those two, I think what we're doing is we're watching the labor report that comes out the first Friday of every month. And if we start to see anything that's going to put more pressure on that, we're kind of expecting that the Federal Reserve may continue to hold rates steady as is.
Yeah, obviously, because again, what they're looking for is they don't want to have it a whole lot tighter employment, again, job market, but they also don't want to see people starting to lose their jobs significantly.
Correct.
Yeah. All right, Cyrus, so what is the third question? I'm dying here. I'm pins and needles.
In 2025, are we going to have the same S&P 500 earnings growth?
Very important.
Yes. So when you look at the analyst estimates for the S&P 500, they're predicting earnings growth rate of 12% for 2025 and 12% for 2026.
Wow, that's pretty robust growth expectations.
It is, considering that in 2024, we're projecting that's going to be right around 10.
Okay, so it's actually going to accelerate a little bit.
It's going to accelerate even more.
Wow.
Better than what we had in 2023, which was a big whopping 0.
Wow, okay.
Okay, so that is why the market now is paying 22 times this year's earnings.
Okay, wow.
Okay, now this is historically higher than the last decade, which we were sitting at 17 times earnings.
Yeah, so again, we would say it's still a little frothy.
Still a little frothy. So is 12% doable? And I'm just going to say, I think so. In the combination of a strong consumer, business capital spending that consistently has been robust. I've said they're going to spend $80 billion.
Yeah.
$80 billion
That's amazing.
this year.
Amazing.
And any uptick that we're going to see from Europe and China, I think all of those are going to be able to provide that stimulus that we need. And not to mention any possible tax cuts that are coming down the pike.
Yeah.
So on top of that, we are also kind of looking at it and saying, here's what some of the things that could trip us up. Okay. And that could possibly be the tariffs and higher interest rates.
Okay.
Both of those would be a catalyst on top of consumer spending, because consumer spending, again, that's 70% of GDP.
Very big percentage.
Very big percentage. So those are some of the things that we're watching. So as a result, this month, we're watching fourth quarter earnings.
Okay.
There's a lot of companies that are reporting earnings this quarter. Not only do they report what happened, but they're also going to give us projections for 2025.
Okay. Very important.
So we're listening for that to determine if there's any mile markers that we need to be aware of so that we can project out for our portfolios.
Yeah, no, absolutely. Well, I think it's also very important to help our clients kind of understand too the difference between earnings growth of the S&P 500 and the performance of the indexes or the stock market. And the main thing again that it is possible for earnings to grow and yet the stock market performance to be flat or even negative, right? Again, with the performance that we see and the valuations that we see today are with an expectation now of 12% growth this year and next year. At any particular moment in time, if that growth expectation is reduced from 12 to 10 or to 8, the market in general, these companies are still making money and profitable. It's just that they're not meeting our expectations, and therefore some of that froth that we talk about is actually going to come out of the market, meaning that the market prices could come down. So again, that's one of the things I think we've talked about a little bit, is expecting a little bit of volatility this year. If there's any hints that we may not hit that 12%, again, it could provide a little bit of volatility as we work our way through.
Absolutely.
The second thing, again, that you kind of touched on it is, and on a positive note, is the amount of AI infrastructure spending is mind-blowing at this moment in time. And now it's kind of hard to exactly project again and even talk about it, because again, it so is starting to encompass all different areas of the economy, which is unusual. AI is very tech heavy, right? Tech specific. But one of the things that is happening is that the technology needs energy. And we heard this year that AI consumes this year only about 1% of all the energy produced in this country is going to AI. And we're just the tip of the iceberg. That in just the next 5 years, that AI is projected to consume up to 6% of all of the energy that is consumed and produced rather. And so it is hard for us to understand what are we going to have to build in order to be able to supply all that energy. And all of a sudden now we're seeing all of this money coming out of tech and going into infrastructure companies like energy companies, nuclear companies, and things that are going to have to be able to be built in order to supply all of this energy need, which again is kind of exciting, I think, for us, because it's going to really broaden out the sectors we think that are going to be making money and producing returns here in the future, and not having it so focused on tech. And the last thing I'll say about that is this, that it's interesting watching tech do this, and again, spending $80 billion this year. Sometimes we'd be concerned that these companies are going to overspend and over leverage themselves, basically getting into debt.
Like 99?
Right? Exactly, in order to produce all this stuff. But that's not true. These companies are literally just opening up their checkbooks, and instead of the money just earning interest rate, a normal interest rate, they're writing checks to be able to deploy it and create all this stuff. And so it is something that we don't expect to just happen over the next 6 months and then be done. This is a 5 to 10 year trajectory of additional spending that will be providing, we think, a very nice tailwind to some of the sectors of the market.
Absolutely. In fact, one of the big chip companies is saying that their chips are going to produce 4 times the amount of revenue than what it actually cost them to purchase the chip.
Oh, interesting. Okay. So as much as they're spending on all these chips, they're expecting
4x return.
A 4x return, which continues to incentivize them to keep doing it, keep moving forward. Because again, that is amazing.
Doug, can you share with us some of the high points of success with our models?
Oh, absolutely. And in the last quarter, our models, again, they performed quite well. Part of that was due to our lower level of international stocks that we've been carrying now for about the last 18 months. Especially in the fourth quarter there, that underweight to international has really, really helped us out, because as soon as all the conversations started going around tariffs, international stocks do not like tariffs, and therefore, again, they really had some negative performance, which we were able to avoid some of. The second thing is the type of bonds that we have in the portfolios, which are, for the most part, quite short-term in nature. Now, again, that we've been taking advantage of the situation in which the shorter-term bonds still have got a very, very high level of interest. And we are concerned, and we have been concerned, that some of those longer term bonds, like the 10-year Treasury, and inflation rates, were maybe not always going to get down to the 2% target that the Federal Reserve was hoping for. And if that was true, and the longer term interest rates stayed more normal, historically normal, back to what we had said earlier in that 5% range, that we want to make sure that we're keeping those bonds quite short to make sure that, again, we capture as much interest as possible for our clients today, and also not take the risk that's associated with taking those longer term bets for the future until we figure out where everything settles in at. And that was very successful, because we actually saw the bond market have quite a bit of volatility there as soon as the Federal Reserve started to reduce interest rates. And so again, our portfolios did outstanding in that department. The other thing is that as we work our way through everything, we are expecting there to be a higher level of volatility in the markets, in the models over this next year. And part of that is all the things that we talked about earlier. We've set the bar really high for expectations. And if anything kind of falters or even has a rumor of faltering, we are expecting the market to have a little bit more volatility than it did last year. Now, keep in mind, average S&P volatility from peak to trough in one calendar year is on average 14% dip. Last year, I believe it was 8%, only 8%. And so this year we would expect that, again, we'll probably possibly going back to more of an average level of volatility. And now, again, the good news is that we have very strong processes internally that are built so that our portfolios, your portfolios, are consistently being monitored. And whenever there is a tolerance out of balance that was created because of the markets going up or down or whatever it is, those portfolios and those positions are flagged, and we are able to strategically make trades doing what every investor knows they're supposed to be doing, which is sell high and buy low. And that whole process allows our portfolios to actually take advantage of the situation and thereby make back losses generally a little bit quicker, because we're buying into those positions that are actually causing the losses. And when they rebound, again, we can make back that money all the quicker.
Absolutely.
So again, before we dive too deep into this, I just want to give a quick disclosure that while Trump did win the popular vote and is the new president, he also coming with him is some very unconventional style, we'll call it, and that can again pose some good things and some bad things. And we're today not going to actually try to predict which of these things are good or which of these things are bad. We're just going to kind of lay them out as factual as we can, that this is probably what it's a part of. And then we'll just have to kind of see how things end up working out. So the first thing that, again, is quite clear that has been communicated is that, again, regulation for the most part is probably going to be either the same in various industries or a little bit less regulation in some industries, okay? Lower regulation in general comes with it higher levels of activity in the market or those industries. Now, again, we can all have the debate whether that was a good thing or bad thing, but as from a market perspective, generally that is, again, looked at favorably, at least in the short run.
You get more growth.
Correct. The second thing is taxes. Now, again, taxes are more than likely going to be either the same or lower with a Trump second term. Back to the same question of, is that a good thing or bad thing? I don't know. In the short run, at least the market is probably going to perceive that as a tailwind, as lower taxes generally stimulate activity. On the long term, though, we all know from our last out of the box that the debt level of our country is quite high. And as a result, having lower taxes is not going to help that problem. And at some particular moment in time, it's going to make that problem worse. And I don't know how they're going to work their way back.
We've got to have a lot of growth.
We're going to have a lot of growth to try to fix that problem. The third thing is the amount of geopolitical tension, which we have quite a bit of geopolitical tension in the world at this particular moment in time. More than likely, we are expecting that either, again, the tension amount level will be either the same or actually a little higher with a Trump second term. Again, back to good or bad, I don't know exactly. In the short run, it could actually be bad, right? People don't like uncertainty. And so if as tensions rise, everybody gets uncomfortable. And the next question that we can all try to figure out is, does the additional tension help or hurt for the long-term peace of the country and or the world? I don't know the answer to that, and we will find out as we're working our way through, but it certainly will have a little bit of an effect on the market volatility. And then lastly, fourthly, we've got the communication style used by the administration, both in the clarity and the consistency. This is where Trump sometimes struggles because, again, there are moments where randomly he'll say things and maybe they're great ideas, maybe they're just ideas, and a little bit of a shocking moment for the market. And sometimes, again, there will be an announcement here, and then the next thing you know, there'll be a little bit of an about face. So as we're working our way through, we are trying to understand how does this communication comes out? How consistent is it? How clear is it? And so that we can try to work our way through, because the one thing that we all do know is the market does not like uncertainties. And so if the communication is not clear and it's inconsistent, the market will tend to have a greater level of volatility that we'll have to work our way through. So in wrapping up here, again, Cyrus, I just want to thank you so much for joining me today. Again, it's always a great time.
It is.
And thank you so much for tuning in to us. And also thank you for the trust and confidence that you've placed in us to manage your wealth. Again, just know that our commitment is to do everything that we possibly can to help you navigate the waters of the crazy financial world the best that we can so that you can have a more exceptional life. Until next time, take care.
Thank you.